We now talk separating the sizzle from the steak. In other words, we will be examining the need for diversification in one's portfolio with Doug Turvey, Private Client Portfolio Manager at Cannon Asset Managers. So good to have you with us on the show today.
Evening, Gugu.
Looking at the headline, the first thing I thought was, ooh, what's this about? Famous brands or, taste holdings? But it goes back more into the investment principles that we need to prioritize and maybe separate and understand. But take us back, 2 steps back into the steak to the sizzle.
Absolutely. Well, thanks for having me, Gugu. I think this maybe talks to financial planning. When we're talking about separating the sizzle from the steak, I think it's, are you buying into something that's real, something that has a sound philosophy, something that has substance to it, or are you buying into hype and emotion? Emotion can often get in the way of successful returns in any portfolio or in any investor's horizon.
And it's happened to the best of individuals because you've got practical examples that your colleague alluded to in the release, an article that we saw from Cannon Asset Managers.
Absolutely. I mean, you talk to Tannenbaum, he was offering 15% a quarter. I mean, these are ludicrous amounts. I don't think there's an investment manager in the world that's going to get that over the long term. Fortunately, when we're talking about financial planning, there were advisors that advised on these things. The investors went back to the advisors. They said to them, you have not advised us properly. Where's the letter of recommendation? Had they done the due diligence into these products that were sold and invested in through the hype and emotion? What was lucky is that in going back to these regulated advisors, advisors were actually asked to pay back the money, and we've heard that before. I think even Greece has been asked to pay back the money.
Precisely, huh? Some other people too, but hey, we'll steer clear from that discussion. But I know you're not a psychologist, but maybe if we just unpack that theme of emotions, which obviously drive and often cloud our judgment when it comes to making financial decisions and investment decisions. Why does it happen? Is it the greed element? Is it some kind of rush that we try to experience in trying to making the most out of our buck?
You mentioned probably one of 2 emotions that drive markets, greed, fear as well. Fear and greed are equal to emotions, and as you say, those are what drive your long-term investment returns. I think to give you an example of where people buy into the sizzle, a good example of this is Fidelity's Magellan Fund overseas. It was run by Peter Lynch, one of the most successful managers, a disciple of value investing like Cannon. The portfolio was over $100 billion, being one of the biggest funds in the world. It had returns of around about 29%. Of interest, most of the investors in the fund earned less than half of that. What they were doing in times of sunshines and rainbows, they were buying into the fund at the top. This is at the highest level of risk. Wayne mentioned earlier, buy when there's blood on the streets. Buy when nobody's talking about the fund. And I think that's what people are doing. You need to understand that you're getting into a sound investment, not to say that the investment wasn't, but you need to run the course. You need to stick to your guns and to a philosophy that works over time.
The practical steps, though, that retail investors can take away from this conversation, especially on some of the elements that might be listed, diversification being one of them.
Absolutely. Diversification is absolute key. I'm sure if I had to ask you what you were invested in, you'd probably tell me your pension fund, you'd tell me probably a range of unit trusts, and maybe through conversations with people on the show, a private share portfolio. I could almost guarantee...
Throw in an ETF as well there.
Oh, maybe. Well, those are hugely popular these days. But I would almost guarantee that your portfolio has a massive overlap. I think what's absolute key is to diversify away from that, understand what you're investing in, have an advisor that will tell you what to do, that will give you a letter of recommendation, and that's regulated. Talking about diversification, the market consists of well over 1,000 general equity funds. Most investors would be invested in a portfolio of those. There are less than 10 small cap funds in the market. Small caps is a great way to diversify a large portfolio. Cannon, for instance, has a very popular portfolio called Super Dogs. Now, people are buying into it. It sounds like an interesting name, and it is. It's very different. But there's a lot of substance behind this. It's been run as a model for 20 years. By Dr. Adrian Saville, who's well regarded in the industry. You're certainly not buying into sizzle there, you're buying into a real meaty chunk of steak.
We like that, which is exactly what investors want. And that goes back to consulting the specialists and looking around, and if it looks too good to be true, it probably is, which, like you say, sometimes can cloud our judgment as investors.
Absolutely. I mean, I think there's been a lot of talk in the press recently about looking and quacking like a duck. As you say, If it looks too good to be true, it probably is. I mean, we mentioned the returns that people are promising. They've been buying into hype and emotion. And as we mentioned earlier, emotion is the destroyer of long-term investment returns.
Having said that, though, there are investors who monitor media platforms like CNBC Africa, read through the newspapers in the morning, and there's a lot of noise, especially you heard us in the conversation with Wayne as well. We talk about resources. Oh, China's a concern. Commodity prices at a slump. You know, maybe look at technology stocks or your rand hedges. For you and how you advise your clients in such tough and volatile times, do you teach them to ignore the noise?
Absolutely. I think the key is what you just mentioned, diversification. People are enamored by some of the big story stocks of the day. Naspers, Capitec, SA Breweries. These are brilliant businesses, but they're expensive. One mustn't forget that while the market might be overheated at the moment and people are possibly predicting a sell-off, there are certain sectors within an expensive market where one can pick up stocks at really, really good prices. Large cap industrials, for instance, are hugely expensive, but as Wayne mentioned earlier, the buying into the substance of a mine, it's not going away. It's going to be there forever. The prices are rock bottom. People haven't done well over the last few years by being invested in resources, but they will do well. They will return to fair value and hopefully earn some investors some good returns.
As long as you have a long-term view, right?
Absolutely. Well,
Precisely.
I think that's what it is about. If you're going to be short-term, you might as well go to the casino.
Precisely. We'll leave it on that note. Thank you so much for coming through today. Great speaking to you, Doug. That was Doug Turvey from Cannon Asset Managers.